Welcome to vTalkInsight, market drivers daily for July 10th, 2026. We're an AI capex boom. Fragile energy balances and shifting volatility all collide to reshape the macro picture. AI continues to pull in enormous capital, but questions around funding, credit risk, and crowding are growing just as geopolitical tensions hold an inflation floor under energy and market microstructure pushes volatility into new corners of the system. The core story today is that AI is still sucking in capital at an extraordinary pace, but the quality and sustainability of that spending are coming under sharper scrutiny. On the equity side, memory and data center infrastructure remain at the center of the trade, with SK Hynix, Micron, and a small group of hyperscalers anchoring the earnings narrative. SK Hynix is emblematic of this phase. Its roughly $26 billion U.S. share sale, the largest ever by a foreign company, was multiple times oversubscribed with demand reportedly approaching $200 billion, and the stock notched a mid-teens gain on debut. The company holds close to 60% market share in high-bandwidth memory, a key bottleneck for AI training and inference, and NVIDIA is its largest customer, so it is widely viewed as a pure play on AI infrastructure spending. Crucially, even after pricing its American depository receipts at a premium to the Korean listing, appetite from around 500 institutions remained extremely strong, highlighting how much global capital still wants direct exposure to AI memory. That enthusiasm sits against a tight supply backdrop. SK Hynix plans to roughly double capacity, but new output is not expected before 2028, which suggests that current memory shortages and elevated pricing could persist for several years. Memory's share of AI infrastructure budgets is projected to climb from about 30% this year toward 50% next year, and broader AI-driven data center spending is expected to accelerate again, reinforcing the case for durable demand into the next cycle. At the same time, a lot of that growth is arguably already in the price for leading semis, and investors are alert to past patterns where extreme volatility in chip stocks preceded significant drawdowns. On the platform side, Meta is trying to shift the conversation from sheer capex to monetization. The stock has outperformed recently after reports that its compute capacity could rival or even surpass OpenAI and Anthropic by year-end. Management is laying out multiple revenue pathways, from renting out compute and launching low-cost generative models via application programming interfaces to potential consumer subscriptions and enterprise cloud-style offerings. That clearer roadmap has eased some investor skepticism about heavy AI spending and comes at a time when Meta's valuation multiples are near the low end of their range since late 2022, which many see as leaving room for re-rating if execution improves. Below the equity surface, the funding side of AI is getting tougher. Oracle has been downgraded to just above junk by a major rating agency because of balance sheet strain from AI infrastructure spending, underscoring that not all capex will be financed on the same terms as in 2023. Recent AI-related bond deals from large private tech names and mega-cap platforms have also met weaker demand and soft secondary performance, pointing to early signs of fatigue in the credit market for this theme. That matters because sustained AI capex by a handful of hyperscalers is critical for the whole memory and hardware supply chain. If their ability or willingness to fund that build-out is questioned, earnings expectations for suppliers could reset quickly. In Europe, AI is starting to look more like a broad earnings driver than a niche story. Roughly 40% of the MSCI Europe Index is now exposed to AI capex in some form, and many regional semiconductors are only just seeing stronger earnings momentum. At the same time, non-AI compounders are still delivering, which has encouraged some investors to think in terms of a barbell between AI-exposed names and more stable growth franchises to manage volatility. That approach reflects growing concern that AI returns are becoming highly concentrated, with both equity and credit performance tied to a small group of big spenders and suppliers. Layered on top is a mounting debate about whether current AI investment has bubble-like characteristics. Capital inflows and valuations in parts of the ecosystem already exceed prior tech booms. Yet near-term revenue and productivity gains remain heavily skewed toward a few leaders. There is also realism about what current models can and cannot do. Many generative systems still struggle with real-world prediction because much of the underlying data is inherently noisy, and research is shifting toward more abstract representations and reasoning rather than brute force prediction. Policymakers are responding as well. The Federal Reserve has set up an AI-focused task force, and recent commentary frames AI as potentially inflationary, in part because memory and hardware prices are filtering into consumer inflation gauges like CPI and the Personal Consumption Expenditures Index. From macro standpoint, the U.S. economy looks uneven beneath the AI boom. Real growth is running below 2%. Real estate is soft, but investment in AI-related equipment and software is robust enough to offset some weakness elsewhere. Labor data show unemployment claims actually down year on year. So widespread AI-driven job losses have not yet materialized, and that resilience raises the risk of wage pressure if automation benefits are slow to diffuse. Looking ahead, many expect AI to cause more visible job disruption among white-collar workers, and concerns are rising that the U.S. social safety net is not well equipped to handle large-scale displacement, especially compared with Europe. All of this feeds back into portfolio construction. AI-driven investing agents have outperformed simple 60-40 portfolios in backtests. But as more capital adopts similar approaches, the edge from those strategies is likely to erode and crowding risks rise. With market upside increasingly dependent on earnings guidance and capex plans from a small cluster of major AI spenders, any signal of belt tightening could trigger swift repricing across semiconductors, memory, and platform names. Key watch points now are guidance from hyperscalers, the pace of AI-related bond issuance, and whether demand for offerings like SK Hynix remains this strong once the initial wave of excitement passes. Geopolitics and energy remain tightly linked, with the Strait of Hormuz still a central pressure point, even as headline oil prices look contained. U.S. and Iranian forces continue a pattern of tit-for-tat strikes, and while technical-level peace talks are ongoing, they have not rebuilt trust, so tanker movements through the choke point stay under close watch. Markets are laser-focused on the volume of ships transiting safely, because even with partial reopening and a backlog cleared in June, persistent security concerns are preventing a full return to normal flows. Despite that backdrop, crude benchmarks like Brent are trading in a relatively narrow range, helped by record production from the United Arab Emirates, which is now effectively operating outside traditional OPEC constraints. Saudi Arabia has even cut its official selling prices, offering material discounts and further reductions for Asian buyers, underscoring the effort to stimulate demand in the face of ample supply and subdued prices. At the same time, the International Energy Agency warns that renewed hostilities in the region could derail efforts to rebuild global inventories, so the apparent calm in flat prices masks a wide fan of outcomes into year-end. The real pressure point is in refined products rather than crude. Diesel crack spreads have surged as Russian strikes on refineries and reduced global refining capacity, especially in Europe, tightened supply. Russia's reduced exports of refined products are contributing to elevated diesel prices in the U.S. But this issue is not currently a top priority in Washington, which is more focused on headline gasoline costs ahead of elections. China, for its part, has relaxed refined product export quotas, signaling a willingness to re-enter the market. If those flows materialize, they could increase crude demand and tighten overall oil balances, even as they ease some product shortages. Shipping dynamics add another layer. Freight costs for crude and refined products dropped sharply in June, with some routes down more than a quarter. Yet volumes remain low and investors are still assigning a significant risk premium to tanker equities. That reflects the view that rerouting and elevated insurance costs are likely to persist as long as Hormuz tensions continue, even if day-to-day price action in oil looks benign. In this environment, the divergence between physical market tightness in specific products and more relaxed financial pricing for broad energy indices creates scope for surprise repricing if there is a further supply shock. U.S. domestic politics are central to the near-term path. With midterm elections approaching and concerns about both recession and high pump prices, the administration has strong incentives to avoid a major regional escalation. Policy focus is therefore on keeping gasoline affordable by encouraging higher oil and gas flows, supporting technical talks with Iran, and aiming for at least temporary ceasefires to manage tensions through the electoral calendar. Most observers expect a cycle of limited engagements, intermittent truces, and ongoing negotiations into the vote, with a higher risk of a more decisive break in either direction once those political constraints ease. Beyond the Gulf, global security dynamics are also shifting. Spain has sharply increased defense spending and now ranks among the top NATO contributors, which improves its standing within the alliance and may help reduce some trade friction with the U.S. At the same time, U.S. munition stockpiles have reportedly fallen by roughly 2/3, fueling debate over the sustainability of high-intensity operations and accelerating interest in new technologies such as drones and AI-enabled systems. These trends suggest a long runway for defense-related capex, adding another structural demand layer to an already crowded investment landscape. On the corporate side, airlines are a useful barometer of how energy and geopolitics bleed into the real economy. Delta has reported solid earnings with resilient demand, particularly for premium seats, and has maintained or even raised its full-year guidance. However, management acknowledges that high fuel costs and broader macro uncertainty remain key risks, and ticket prices are expected to stay elevated as carriers try to protect margins. Upcoming airline results will therefore provide fresh insight into how consumers are absorbing higher travel costs and whether the combination of energy prices and geopolitical anxiety begins to weigh more heavily on discretionary spending. Stepping back, the balance of evidence points to a persistent energy-related inflation floor rather than an imminent spike. Crude supply is currently cushioned by the UAE and other producers, but refined products are tight and Hormuz remains a live risk. For macro and multi-asset investors, the key signals to track are tanker throughput in and around the Gulf, the trajectory of diesel and jet fuel spreads, and any shift in U.S. political rhetoric as midterms draw nearer. A surprise disruption to shipping or a failure of diplomacy after the elections would likely reprice both energy assets and rate expectations much more violently than the calm and spot crude suggests today. Turning to volatility, what stands out now is not a simple rise in index-level fear, but a deeper shift in where and how risk is showing up across markets. Headline indices can still look orderly, yet under the surface single stock and thematic swings have moved to historically elevated levels, reflecting both structural and behavioral changes. Korea offers a clear case study. The Kospi Volatility Index is trading far above comparable gauges in Hong Kong and the U.S., prompting many investors to cut position sizes despite strong interest in AI-related names. SK Hynix again sits at the intersection of these forces. Volatility around its massive share sale was intense, with fundraising totals and secondary pricing moving sharply as the AI trade in Asia whipsawed. New leveraged exchange-traded funds built around the stock and broader memory themes are expected to add another layer of optionality-driven flows, amplifying both liquidity and price swings, particularly if the name gains more weight in major chip indices. In the U.S., NASDAQ futures are under pressure after an AI-driven rally reversed, highlighting how crowded long positioning in big tech leaves the market sensitive to even modest shifts in growth or capex expectations. Despite the index being up double digits year to date, the average constituent has experienced a maximum drawdown around 40%, underscoring the dispersion and rotation happening beneath the surface. Semiconductor stocks in particular have seen frequent large daily moves reminiscent of prior pre-correction phases, and earnings season is characterized by a wide gap between sell-side and buy-side expectations, which is magnifying reactions to every data point. Volatility is not confined to equities. In the U.S. Treasury market, ownership has shifted more toward hedge funds running basis trades, meaning they're long cash bonds and short futures or vice versa to exploit small pricing gaps. That structure can work smoothly in normal conditions, but it tends to make the market more sensitive to risk-off shocks because those trades can unwind abruptly when funding costs or margins change. Against a backdrop of rising yields in parts of the curve and geopolitical uncertainty, this setup argues for close monitoring of duration risk, even if headline bond volatility looks contained for now. On the behavioral side, younger investors are increasingly shifting from broad index exposure toward higher risk assets, including meme stocks, cryptocurrencies, and complex option strategies. Social media is accelerating this trend, and so-called YOLO trades are becoming more common, with Gen Z traders displaying a higher tolerance for leverage and drawdowns than previous cohorts. While the absolute size of this capital pool is still modest relative to institutional flows, it can drive sharp short-term dislocations in individual names and thematic baskets, especially when combined with thin summer liquidity. Market structure is reinforcing the new volatility regime. Leveraged and thematic ETFs have already amplified upside moves in favored areas like AI and semiconductors, and there is growing concern that they could magnify downside shocks if sentiment turns. Single stock volatility has risen to record highs relative to indices, signaling extreme dispersion that makes stock selection harder but also increases the potential impact of crowding around popular narratives. At the same time, trading volumes have dropped markedly after a very active June, suggesting that the combination of lower liquidity and higher leverage could produce outsized moves on relatively modest news. In response, many investors are maintaining elevated cash balances, helped by attractive yields, using cash as a buffer against valuation uncertainty and episodic shocks. There is also more interest in barbell-type positioning, combining AI capex beneficiaries with steadier non-AI compounders as a way to smooth portfolio-level volatility without abandoning growth themes entirely. Looking ahead, the key variables to watch are how earnings surprises land in high-beta sectors, whether basis trades and rates stay orderly, and how far leveraged ETF flows and retail risk can continue to shape intraday price action. To wrap up, AI remains the dominant macro and equity driver, but the story is evolving from pure growth to one where funding costs, concentration risk, and policy responses matter just as much as top-line demand. Geopolitical tensions are keeping an energy-related inflation floor in place, even as crude trades in a range thanks to record supply elsewhere, leaving a wide set of potential paths for both commodities and rates. And the volatility regime is shifting toward higher dispersion and more technical fragility, with leverage products, basis trades, and retail flows all playing bigger roles beneath relatively calm indices. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.